The IRS provides an additional tax break if your spouse passes away and you're left with at least one dependent. But it's not your typical tax credit or deduction. It actually comes in the form of a short-term special filing status, which is called qualifying widow or widower. Here's how it works. You don't file as a widow or widower for the year that your spouse actually passed away. That filing status is for the next 2 years afterwards. For the year that your spouse died, you can file as a married filing jointly so long as you don't remarry and the executor approves the joint return. Make sure to include your income and deductions for the full year and your spouse's income and deductions until the date of death. Also, be aware that you as the surviving spouse may be liable for any taxes owed by the deceased spouse that the estate can't pay. For the next 2 years, you'll get to file as a widow or widower. This filing status gives you a higher standard deduction and a lower tax rate than filing as a single person. There are some qualifications to be met though. You'll only qualify if you haven't remarried, have a dependent child who lived with you all year, and have paid over half the maintenance costs of your home. So here's a recap. If you are a widow or widower with at least one dependent, use the married filing jointly status for the year your spouse died. Then, for 2 years after, you can use the qualifying widow or widower filing status for a higher standard deduction and a lower tax rate.